All right, we are live. And if you guys want to get a free Tradeline e-course, you can go to simplepassivecashflow.com before September 15th. Shoot me your lucky number between 0 and 99 for a chance to win one of these free Tradeline e-courses valued at, I think it's 200 or 300 bucks. But if to learn more about what trade lining is, go to simplepassivecashflow.com/tradeline. I made about 10 grand in 2019 doing this. Great way for non-accredited and accredited investors to play some small ball, make some money off the credit cards you already have. If you haven't found my podcast, check it out. It's simplepassivecashflow.com. But let's answer some questions from listeners. Here's a simple question that got sent in. So stocks or real estate? So here's where I'm obviously a real estate guy. I like real tangible assets that cash flow, you can leverage and have great tax benefits. Stocks, I just think they lack this tangibility of like a real asset. There's so much price fluctuations, and real estate on the other hand, it has very good, just solid investment where you can physically walk up to it, and it produces cash flow too. If you're buying something that is 1% rent to value ratio or higher, um, real estate, you have the control over it. You can ability to put in property managers, buy it, sell it, tax advantages, with the depreciation of rental property, and then now with bonus depreciation, something you don't get with other asset classes, such as buying, gold, silver, stocks. Um, I think like real estate is very understandable type of business, whereas a lot of things in stock land I don't, quite frankly, don't understand. And not only can you leverage your money with these government subsidized loans, but you can also leverage other people and put the right people in place on your team. But kind of a vague question, but that's kind of where I'm at. I don't have any stocks. Every time the S&P goes up and down by 5% in one day, I don't care one bit. COVID-19, the commercial real estate that I'm involved with did not change one bit. And I'm even more confident in investing in workforce housing. And I urge everybody to do the same thing. But I get it; it's not for everybody, and not everybody's going to have a 100% non-paper assets portfolio. But try it out, and let's go on to the next question. Oh, if you guys, we are live here, so if you guys would like to ask any questions, please put it into the comment section on the YouTube channel, and we'll answer it there. Or if you guys just want to submit questions online, go to simplepassivecashflow.com/question, and we'll get it in the queue for next time. All right, so this one has to do with insurance. Do I need to do due diligence on this item now? So this person is looking through their spreadsheet on their analyzer, which you guys can get access to that at simplepassivecashflow.com/analyzer and download your free single family home analyzer. But one of the big line items along there, along with many more, are the insurance line item. And this investor do they need to figure this line item out now, or wait till a property is under contract? They don't want to create any more work for themselves at this time. And yeah, I don't want you to do any more work, or more importantly, waste your insurance broker's time to run a quote for you if you haven't even got it under contract yet. So I would say if you haven't put in an offer yet, I would use the rule of thumb that we have in the analyzer. I think it's somewhere between like 1 or 3% of the property, right? Something like some percentage. I don't know if it's that much, but it's in there in the footnotes that I have. But once you get the property under contract, you're going to have about a month before the deal closes to really run your numbers, especially before your due diligence period runs up, to email out your broker and get a couple of quotes. And if you guys need any, I have a couple providers that I recommend. If you guys need any referrals, please shoot me an email link at Simple Passive Cash Flow. We can hook you guys up there. Another free giveaway here, network tracker sheet. can download this at simplepassivecashflow.com/legacy, but you put it in your age, how much you're able to put to savings. Most of the people in our group are able to save at least $30,000, and you can play around with this, how much your rate of growth is. And I think what's really cool is you can compare, those normal folks making 5% returns, and then a 10% and 15%, how that really takes off. All right, next question. I have maxed out my conventional loans allocation and looking to move into other types of lending to continue to expand my portfolio. Can I ask for your advice and potential pitfalls to look out for? So what this investor is talking about is their conventional loans, which is our Fannie Mae, Freddie Mac. So Fannie Mae, Freddie Mac allows each individual to get 10 loans in their name. Fannie Mae and Freddie Mac are great loans. They're sort of backed by the government and a little cheaper. And they're the 30-year fixed amortization loans. Today, I think you can get them in like the 3 or 4% range. The little trick that a lot of people do is they put 10 in their name, 10 in their spouse's name. So when they go and get a loan, they don't put the loan in the couple's name. They put it in one person's name on purpose, because each person is able to get 10. And as a couple, you can get 20 if they do it that way. But I think maybe this question's maybe a little bit nearsighted. Like I thought, and I get where it's coming from. Like I thought I was going to have 10, 20 rentals myself and get Fannie Mae, Freddie Mac out to take advantage of all my loans. But I quickly realized when I got up to 11 rental properties that single family home rentals is not scalable, and it is not what high net worth accredited investors do, because it's not scalable. And it's kind of funny, once I joined a bunch of different masterminds and groups, this is exactly what these individuals were saying, who are doctors, lawyers, engineers, 10, 30 years older than myself. Is they all thought it was really cool to get 10 in their name, 10 in their spouse's their name. They thought they were really clever, but come to find out, that's not how high net worth investors invest. They invest more in syndications and private placements, and they get out of actual owning the properties directly because they don't want to get any loans in their own personal name. They don't want the liability, and more importantly, they don't want the headaches of dealing with the management or even managing the manager of these rental properties. And the rental properties, they're just not scalable. So I would say if you're asking this question and you had more than 5 or 6, maybe take a look at what's going on in the syndication world. It might be time for you to step up. Certainly if your net worth is under $250,000, $500,000, I'd say you probably should still focus on picking up your own direct rentals and getting your net worth up, because most of the syndications are around $50,000 minimums, at least the ones you'd like to get into. There are lots that are $25,000 minimums, $10,000 minimums, but to me, the operators are not experienced at bottom rung. But up to you. Whatever you want to invest in, that's fine. I just wouldn't do it. I started investing real estate this year. My first 3 were from turnkeys. My last 2 were through an agent relationship. Not sure what my next step is. Thinking about getting a project management company to do a BRRRR. Not really sure. Would like some consulting, I guess. All right, so for those of you guys don't know, BRRRR is this acronym standing for Buy, Rent, Repeat Finance, where it's supposedly a clever way of making your dollar stretch. So you buy a property outright, fix it up, rehab it, and then refinance all your original capital back out. In theory, it sounds really cool, but as high net worth accredited investors, and I would say anybody with more than like a few $100,000 and high paid professional jobs who are busy, especially for those not starting out, I don't think that this is a great way to build your wealth. I think you can make a lot of money doing this, but I think it's not worth the risk. Always trying to find the best investments that have good risk reward profiles. And I think BRRRRs are fine if you don't have that much money and you need to roll the dice and take some chances. But for a lot of people making over 100K at their day job, I would say that it's not worth the time and the risk. Time is one of them. It takes a lot of time to manage these guys, and especially if you're remote. investor to. It's bad enough being a remote investor with these turnkeys because these property managers, what you'll find is that they'll gouge you with higher than normal um, pricing. And you don't really have any recourse. It's like trying to fight with one arm behind your back. And now you're kind of getting into the world where you're working with 10, 20, $30,000 of construction scope at the very least, and now your issue compounds itself. I think it's just a matter of time before you start working with somebody who screws you over. This is again why I don't like to work with anybody in terms of a partner who's not an accredited investor. Not saying they're better people, but I would think that a accredited investor would they wouldn't screw me over for 30 grand, because 30 grand isn't worth it to them too much if they're incentivized to the deal too. I just think when you're working with a contractor, a lot of these guys are just living paycheck to paycheck, and I just haven't seen anybody do this for a long extended period of time where they haven't just gotten screwed over by somebody. So it's simple passive cash flow. We kind of work with more high net worth clients, certainly above $500,000 net worth on average. And the BRRRR is not for us. It's kind of for broke people. That's broke. Not saying that that's anything wrong with that. I used to be broke, and I just bought a bunch of turnkey rentals, and I just let time build up for me so that with the mortgage pay down, the appreciation, and just the cash flow accumulate. From 2009, I bought my first rental, and it wasn't up to 11 rentals until 2015. But I think people like to do the BRRRR to push it because it sounds cool. And I would just urge people just like figure out, going back to my net worth tracker sheet, right? Just track where your net worth is going to go. If you're on track, why would you want to take on more risks than you need to? Next question, do you use a particular program to keep your investments organized? So here on the screen here, I took a screenshot of my personal ledger, which I'm using a very complicated program called Microsoft Excel. You can also turn it into Google Sheets, and I say that kind of jokingly because it's nothing very special. I know a lot of people will use QuickBooks. That's another option, but me personally, I know how to use Excel pretty good, and I can customize the stuff the way I want. So basically what all I have here is, if you go and Google the Schedule E, that's essentially the items that you have to record. So the spreadsheet is doing, it's pulling from some other individual tabs, each of these properties. So like I have a property at 20th Avenue, 5th Avenue, Spring Lake. And on the bottom of the spreadsheet here, I have the individual tabs that account for that one property. But these individual tabs will lead up to this one, propagate this. So it's being summed up here, and this is the sum. Actually, this is the sum here. And I have it spread out in terms of what is found on the Schedule E. This is what I put on the header on each of these individual property pages. And the government wants to know how much is the rents, the royalties, the advertisement, auto, TYE, travel, expenses, cleaning, maintenance. So that's what the data I'm going to collect, and that's what I'm going to sum up to put on my tax form. And this is what I give my CPA. I do a lot of this bookkeeping myself because I got to keep it anyway, and I just figure that if I keep my records, I can save some money on the bookkeeping fees. But it's not really saving, like the thing is not saving money. It's like you should know this stuff yourself. You should know where your numbers are. So I figure like I have somebody helping me with doing my books, but at least this way I don't have to explain it to my CPA, and I don't get lost, and I kind of know where how much expenses I had too. So yeah, I use Excel, but again, I think a lot of people will use QuickBooks too as another option. Next question. Hi Lane, when you are calculating the rent to value, do you use TMV or the retail value? I don't know what TMV is, but maybe you're talking about like you use like where do you get the market value from? And then sometimes it's different from the retail value. I would be using the value that you're realistically going to pick up that property from for. So for example, I think sometimes you'll see a lot of these turnkey rentals as coming up as worth 20 grand on Zillow because it's a piece of junk, right? That's the rehabber picked up that piece of junk and they put maybe 20 to 40 grand into it. And now they're trying to sell it to you at a retail value of 80,000. Um, I would be using that $80,000 value. Essentially, that's what you're picking it up for. That's the market value, retail value, this case, and then you use that to go the monthly rents divided by that value, the 80 grand. That is your rent to value ratio. Some people are they. I don't really think that this is a good idea, especially for your first property. They'll try and find a $60,000 property that has some rehab, so it's not a heavy value add burr, but it's a light value add, which I defined as maybe about $10,000 of rehab for a house. What I would do is I would add that into what you pick it up for. So if you picked it up for 60 and $10,000 of rehab, I would consider that as $70,000 in your rent value calculation. So you want the thing to rent for at least $700. But that's what I would use it when you're doing a burr. But again, I don't really recommend doing the burrs. Kind of going back to that again, when you're doing a burr, you have to have all your money in the deal, and it has to sit there. They say that you can get it all done in 3 months, but you're at the mercy of the bank, and you're at the mercy of the bank for the right appraisal price too. So you may not be able to pull out all your equity. The argument that I make is like just stick it in something like AHP, make 10%, or go buy a rental property and just let it go, right? I think when people are trying to put all their money in and then trying to pull it all out, I think the time value of money, like it just would have been better just sitting there. Certainly it's probably better there, like based on like the brain damage that you go through and the risks that you take, especially for a high net worth investor. Last question here. Where to start in real estate investing? I'm overwhelmed with too many options. So yeah, I think it is very overwhelming, this real estate investing world. But I think you gotta like separate things out in terms of like more active activities and more passive activities. Active activities are things like the burr strategy, wholesaling houses, flipping houses, tax liens, all these no money down strategies. Like here at Simple Passive Cash Flow, we don't really do that stuff. Most of our clientele are high paid professionals, or they're able to save a decent amount of money every year to put to investing. And maybe they might get more active later, but I think Simple Passive Cash Flow, the passive way, the turnkey way, initially when you're starting out is the better way of going. Um, Here we focus on if you're under $250,000, $500,000 net worth, just focus on getting a turnkey rental, especially if you live in a place like California, Seattle, Hawaii, primary markets where the rent to value ratios aren't higher than 1%. Just pick a market, secondary market, where you can find a good referral and build a good team of property manager around you and brokers to just go pick up that first rental property in a decent area that rents for at least $900 a month, that has a rent to value ratio of 1%. So again, the criteria again is a good property that rents for at least $900. To me, that I use $900 as a sort of a indicator of like I just see a lot harder tenant class when you go below that threshold. I don't really want to have new investors work with class C tenants, and then I want to see that rent to value ratio of 1% or higher. So at the very least, I would say start off with that. If you want to get more active and you want to start employing a lot more advanced strategies, then cool, knock yourself out on the second one. But I tell people like just start off on the shallow end of the pool, learn how to like put your head in the water and kind of get comfortable with the water before you go jump into this deep end of the pool. And which is hard because I think a lot of people aren't working with that much money. So the allure of a $60,000 house that rents for supposedly 750, 800 seems more alluring, or to buy even cheaper house. But I mean, I would rather see people start off with the easy stuff and then kind of work their way up. Um, Again, I think this is not a get rich quick thing. This is, you got to be patient and build wealth over time. And it may be more of a money problem. If you can't save 20 grand a year at your day job, maybe there might be something wrong with your personal finances, which we'll start to build more content around the whole holistic personal finance. Spending money in the right things, buying more value, being frugal with your money, so you can save the money to go put into investing. Again, that's what for a lot of people that are not saving more than $30,000 a year. A great thing to get into is trade lines with your credit cards. Again, if you want to email me your lucky number between 1 and 99, shoot me an email before September 15th at laneandsimplepassivecashflow.com, and maybe you can win one of the 3 e-course giveaways there. But yeah, that will wrap us up for this time. If you guys want to check out or leave a question in the comment below on the YouTube channel, I'll try to answer it there. Or submit questions for next time at simplepassivecashflow.com/question. And I'll see you guys next time. Have a great weekend. Bye.